if I don't want to own 100% Bitcoin, but by the way, it's like people think it's risky to own Bitcoin because it's volatile. That's basically myopic thinking, because what you're doing is you're putting blinders on and you're fixating upon the volatility of Bitcoin instead of looking out. How much did the volatility of Bitcoin hurt you if you own Bitcoin in Lebanon? Because they devalued the currency 90% and they seized and froze all the foreign assets. So you lost 90 to 100% of everything in 12 months. Okay, so the volatility of Bitcoin, which is up 280% in US dollars and going back and forth, is, a friend of mine says, when there's blood on your collar, your dry cleaning is the least of your concerns.
This poll came across my feed today. I was shocked that 64% of 51,000 votes think Bitcoin is a scam. I went to this Charles's YouTube. It is a shorts channel and its content is pop culture and news related. Maybe I was shocked because of how long I've been committed to Bitcoin. I was initially taken aback, but after some thought, it just proves that we are still early to Bitcoin. I looked back and my first Bitcoin purchase was December 9th, 2013. I bought a tenth of a Bitcoin for $107. Bitcoin was trading at $1,064 and I thought I bought too high. So I've hodled Bitcoin for almost 10 years and have lived through the massive volatility that comes with the territory. After all that volatility, I have to admit that my stomach turned when I looked at my US dollar balance yesterday. It gets easier but never goes away. I don't pretend to know the future price, but I'm convinced that the US dollar will be worth much less, if anything, in 10 years. And one Bitcoin will still be one Bitcoin. Today's clip is Michael on Benjamin Cowen's YouTube channel, link in the description. This clip is from 2 years ago and has Michael talking about diversification theory and how that doesn't always make sense. Enjoy the clip.
If you want to construct a portfolio, you have to start, let me just start with one observation. This whole idea of, the right thing to do is have a diversified portfolio is in and of itself just a prejudicial bias. It's like, it's not even true sometimes. It would be true under certain circumstances, but just allowing people to put that in your head is ridiculous. For example, it might turn, if I knew that everything was going to zero except for one thing, if I knew that, right, then it doesn't make sense to have a diversified portfolio. And you have to actually think more deeply about the macroeconomics here. And the macroeconomics and the political and the social economic dynamics would determine what is your state space of potential choices. You're on the Titanic is sinking, you're going to die, and there's one lifeboat, and you've got 10 people in your family. Okay, do you actually put one person in the lifeboat and the other 9 stay on the Titanic, or do you all get on the lifeboat? Because you're going to die if you stay on the Titanic. Everything is sinking, right? You're on an airplane and we blow out the window and oxygen's coming out of the cabin, an oxygen mask drop down from above. Does everybody put on the oxygen mask, or does just one person or 2 people or 10% of the people put on the oxygen mask? If you're in a life or death situation, portfolio theory is ridiculous. And if you're in an engineering situation, if you're building a building and you have a portfolio of clay and bricks and aluminum and brass and copper and steel, and you can choose anything to build the building with, diversifying and using some clay and some copper and some steel is not the right answer. There is a right answer under an engineering constraint. You build a plane in aluminum, you build a building with steel. When we didn't have steel, we had iron. And before iron, we had masonry. And the buildings were 6 floors high. And when there's a new technology, which is better, it completely invalidates the previous science. So let's look at portfolio theory. Well, there's a lot of arrogant presumption in portfolio theory. Like, if I put you, let's take this example. If you were in Lebanon and the pound is 1,500 pound to the dollar, and if I were to tell you that the currency is going to crash, you're going to lose 85% of your value in every locally denominated currency and currency derivative. And your choice is a market basket of Lebanese stocks, Lebanese real estate, Lebanese currency, Lebanese bonds, or Lebanese savings accounts, or the U.S. dollar. So what's your portfolio theory tell you? Like, tell me what your diversification strategy is. Should you diversify? Because every single thing other than the dollar is going to go to minus 80% next week. No diversification makes sense. They're all correlated to the currency. And so you think you're diversified, but the real question is, like, let me put you in a different situation. You're in Germany, right? And the Nazis are about to take over, or you're in Germany and they're about to lose the war. Okay, tell me what your diversification strategy is across all German real estate, bonds, stocks, or whatever. If the government fails, or if you're Jewish and you're about to get thrown into a concentration camp, the overarching issue is everything you can invest in is correlated to the political situation. In Russia, when the communists take over, they're going to seize all the private property. So having a diversified portfolio strategy of properties that are about to be seized by the government is a waste of your effort. So the real question is this portfolio of things correlated? Because most of these things, like for example, today, every stock is a currency derivative. Every stock is valued based upon the expected cash flows of mostly US dollars and to a smaller extent euros. And every bond is a currency derivative. And and all the derivatives are currency derivatives. And all the commercial real estate is a currency derivative. And all the ETFs are currency derivatives. So, and all the currency obviously is currency derivatives. So 90% of what people think they're diversifying into is all correlated to the US dollar. And the US dollar was devalued by something on the range of 30 to 40% in the last 12 months. If we look at performance over the last 12 months, S&P is up 39%. The S&P generally is up 10% a year for 100 years. So 39% means a 29% collapse. Plus, the dollar was already being devalued at 7% a year. So you could say that backing out the risk premium of holding the stocks, which is traditionally 3% a year, you had a 36% devaluation of the US dollar in the past 12 months. Which meant that was a 36% devaluation of all value stocks, all cash, all bonds. If you're holding a bond that's yielding 4%, you've got a negative real yield of minus 34% in 1 year. So to be extreme, what's your diversification strategy if you're holding Argentine equity and debt and real estate? Because the inflation rate there is 85% informally right now. So when you say, should we diversify? The answer is, let's come back to Lebanon. The only answer is you had to convert to dollars, but that didn't work either because they seized all the dollars in the banks. Like they froze all the accounts. So it only works if you diversify to a hard asset and then you get it out of the political jurisdiction where it might be impaired. So we come back to your question, like, how do I view the world today? I think that the first issue is the currency is being devalued everywhere in the world. It's being devalued at the rate of 20% or more, at least in the US. Every other currency is pegged to the US currency. If the US currency actually just collapsed 37%, which is what the S&P index is pointing to, that means the euro collapsed 37% against scarce assets. That means the Chinese yuan collapsed, the CNY collapsed 37% because it's pegged. That means that the Saudi currency, the Emirati currency, the Swiss currency, the Singaporean currency, every first world pegged currency collapsed 37% against scarce assets. Second and developing world collapsed 20% more. And the third tranche, the weak currencies, Zimbabwe, Venezuela, even Argentina, Syria, Iran, Lebanon, they're collapsing 80% against scarce assets. So now you got to ask the question, what if I don't want to own 100% Bitcoin? But by the way, it's like people think it's risky to own Bitcoin because it's volatile. That's basically myopic thinking, because what you're doing is you're putting blinders on and you're fixating upon the volatility of Bitcoin instead of looking out. How much did the volatility of Bitcoin hurt you if you own Bitcoin in Lebanon? Because they devalued the currency 90% and they seized and froze all the foreign assets. So you lost 90 to 100% of everything in 12 months. Okay, so the volatility of Bitcoin, which is up 280% in US dollars and going back and forth, is, a friend of mine says, when there's blood on your collar, your dry cleaning is the least of your concerns. That volatility is second or third order. If the airplane is depressurizing, you're worried about the hygienic standards of the oxygen mask. Who gives a crap? You're going to be dead in 60 seconds, right? When the ship is sinking and you're worried about whether you got the best seat on the lifeboat or try to figure out whether you wanted this one or that one, you're going to be dead in 2 hours. So if you have if you're Jewish in Germany in 1932, the only answer is you needed to leave. That's the only answer. There was no other answer. It was just going to get progressively worse. And you're screwing around debating whether you should take a 25% haircut to sell you. Everybody, if you read the history, first they sold their property for a 40% discount, then a 50%, then a 60%, then an 80%, then a 90%, then a 95%. Then they lost everything. Then they had to pay a ransom to get out. And if you were lucky and you paid, a huge amount of money, that came from somewhere else, you might have got out. That's what happens when you have a collapse in a socioeconomic system. So the summary is there's no diversification strategy that works in Venezuela, Benjamin. None. There's nothing that works other than you got to go orthogonal to the monetary system. So let's say in the U.S. we buy the notion that the dollar is collapsing 20 to 35% against scarce assets, and we can debate what it is, but it's at least the M2 money supply is 21% or something. The S&P is telling you that the money supply is that the currency is collapsing 37%. That's what it's telling you based on history. So if you don't want to own all Bitcoin, then my advice would be buy a bunch of residential real estate you're going to live in the rest of your life. Buy a beach house. So I buy a house I want to own the rest of my life because the Federal Reserve can't print that away. They're not going to take 37% of my house away each year. Okay? That's good. Then I buy scarce assets. You could buy collectibles. You could say, what is a good investment? Something that a wealthy person will want to buy from you in 10 years. Buy a franchise trophy asset. If you have an asset like maybe the Jets, maybe a sports team, if you have an asset which you think is going to hold its value and appeal for the affluent for a decade, regardless of what a politician might do, then you might want to hold that. Do you want to hold a building in New York? Well, your property rights can be impaired. The Supreme Court this week just ruled against eviction for non-paying tenants. So if you were holding an apartment building thinking that was an asset, that was impaired during the lockdown, and you can't move it. So I don't know, maybe. I wouldn't own cash. I wouldn't own a bond. Bonds have a negative 20% real yield. Now, what about gold? I wouldn't own gold. Gold is if we look at the results, what is the market telling you this year about store of value? Bitcoin is up 276%, gold is down 2%, S&P is up 39%, Nasdaq is up 43, 44%. And if you bought long dated bonds, 10 to 30 year treasuries, you're down 12%, which totally makes sense because it'd be stupid to buy a 30-year sovereign debt that was yielding 1.2% interest, which is where you were 12 months ago. Should you buy Picasso's, baseball cards, comic books? I mean, maybe buy a portfolio of rare art because wealthy people will probably want to buy the rare art off of you. What worked well? Single family housing's up 25%, according to the headlines in the Wall Street Journal last week. 25%. Hampton's houses are up 50%. Luxury real estate, things that are highly desirable that people with money want, right? You want to buy. You would say Ethereum is up even more. Yeah, I mean, there's certainly small. You probably Tesla, meme stocks. You can find other things out the risk curve that have also performed well. So, I mean, you could look at those. My issue here is there's two existential macroeconomic questions you got to ask yourself. One, will a political activity impair the value of your capital? For example, will Amazon get unionized? Will Apple or Google get broken up? Will there be an antitrust action? Will it be positive and negative? Will China ban Apple from manufacturing iPhones? Will there be a tariff? Will your property get impaired by a tariff, a tax, or a regulation? Because Ben, the most valuable companies on earth, in theory, should be the water utilities and the power companies, electricity and water. But they're not, because they're regulated as monopolies. But at the end of the day, right, everybody in New York would be dead within 48 hours if I turned off electricity in New York City. So if I really, and I could kill you with the water supply faster. So if it was really as simple as providing a utilitarian value, then the utilities would be much more valuable. But what happens is eventually the politicians regulate the utilities and then the profit leaves those businesses. So the question is, if I'm holding an equity, will it be impaired by a political act? And the second question is, if I'm holding real estate, real estate's the same way. You own a building in New York, is it going to be impounded, seized, regulated, taxed? I can tax away your property, right? You can't move. $1 billion building in New York isn't moving, whereas $1 billion of Bitcoin can move. If the state of California passes a property wealth tax that seizes 10% of all your property in California and it's a building, good luck with that. Can you sell that to a billionaire in Beijing or a billionaire in Tokyo? Not likely. Can you move it to Tokyo? Not likely. Now, here's the thing about Bitcoin. If I owned $1 billion of Bitcoin and California taxes 10% of it, I can move to Wyoming. If the United States government taxes it, and I can't, let's say the worst case, the United States government taxes it, I'm a U.S. citizen, I could move out of the country, but they still want to tax U.S. citizens. I can sell it to someone who's a Monaco resident, and they can take possession of it in Monaco, subject to Monaco tax laws. And so the value of the property is less impaired because I can transfer it to someone in a different political jurisdiction. And I don't have to worry about the mayor of New York passing an anti-eviction law on me that says is the mayor of New York going to say you can't generate yield on your Bitcoin? Because he said that to people that owned apartment buildings. He said you can't generate yield on your apartment building. So there's risk in real estate. There's risk in equity that's political risk. You have to You have to assess it. Then the question is, what about the currency risk? If the value of the Venezuelan currency goes to zero, then every piece of real estate, every company, every bond, and every currency derivative in Venezuela or linked to Venezuela is going to zero, right? The Argentine peso was one peso to the dollar 20 years ago. It's 155 pesos to the dollar today. If you're a business person in Argentina, there is no diversification strategy. There is no investment strategy that works if it's related to anything that's a peso derivative. So you have to, and you can't keep your money in dollars. I converted all my pesos to dollars. I had $1 million of dollars. It was in a bank in Argentina. On one day, the politicians passed a law, actually by edict. They simply converted all the dollars forcibly back into pesos. The next day, they devalued the peso 10-1. And in 48 hours, they seized 90% of all the currency values in all the banks in the country from 45 million people without due process. That's what happened in Lebanon, too. That's what happened in Cyprus. That's what happened in most of these countries. That's what's happening all the time right now. So you're like, well, that's not a problem in the U.S. Well, it is. The currency of the U.S. has been getting devalued 7% a year for 50 years. Until March. And in March, it started getting devalued at a number which I thought in March, I thought it was triple. I thought it went from 7% devaluation to 21% devaluation. If you devalue the currency by expanding the money supply by 21% and you're getting a 3% yield on a bond, you're getting a negative 18% real yield. You're losing all of your money over the course. Well, you're losing half of your shareholder value in 3 years. Half. But if the currency collapsed at 37%, you're losing half of your money in 2 years.